Good morning, friends. This is CMA Mukesh Joshi this side from my channel H&M Finance, Investment and Corporate Laws. Today, I am going to talk about one of the important concept in foreign exchange market, not in foreign exchange market, even in financial management. What are the different types of foreign currency loans and what is the structure and source of those loans? So friends, basically foreign currency loan can be categorized by their structure. It can be categorized in terms of purpose and source of funds. These loans basically allow businesses, particularly those engaged in international trade, to borrow money in a currency other than their local one, and it potentially benefiting from the lower interest rate, but subject to the foreign exchange risk involved. We want to say that when we get the money from the abroad in foreign currency, when the rate of interest is lower in country from where we want to source the loan, and this loan or the interest is always subject to interest rate risk exposure. Whenever we find that there is some benefit we can leverage in terms of interest rate benefit, then businesses and entities and corporations go for foreign currency loan. The question is whether the foreign currency loan gives benefit to the businesses or not. The answer of this question is it can or it can't. It can benefit when the exchange rate exposure or risk is low, and interest rate differential means our interest rate when is more and interest rate in foreign currency from where the fund to be sourced is lower, then definitely it gives benefit, and vice versa the situation is. In terms of structure and finance, the foreign currency loan can be categorized in mainly four categories. One is foreign currency term loan, second is external commercial borrowing, third is FCNR loan, fourth is buyer and supplier credit. So let's discuss briefly these four structure and source of finance. One is first foreign currency term loan. These are standard term loans provided in foreign currency like USD, Euro, Yen for a specified period. They are often used for capital expenditure like purchasing machinery from abroad. The principal and interest are repaid in the foreign currency to the bank of a foreign currency, to bank of a foreign country. So when we structure our finance this way and we have receivable from that country, so it becomes a natural hedge for the businesses. That's why they use or they take the foreign currency term loan. Second is external commercial borrowing. This refers to commercial loan raised by eligible resident entities from a non-resident lender. Only resident entity can claim or take this external commercial borrowing. Not everybody cannot take the leverage of external commercial borrowing, and it is available in freely convertible foreign currency or INR. They can take various forms including bank loans, foreign currency convertible bonds, buyer and supplier credit. The third is FCNR loan. In India, banks grant loans denominated in foreign currency using their pool of funds from the foreign currency non-resident banking deposits. These are domestic source of foreign currency loans, often offered as short-term facility with a fixed interest rate. Means Indian banks out of their foreign currency non-resident deposits pool, they give the loan to the uh, Indian borrower as a short term facility with a fixed interest rate. That's why it is called foreign currency non resident loan. Last is buyers and supplier credit. So, buyers and supplier credit means this is a form of trade finance where a foreign bank, buyer's credit, or a supplier, that is supplier credit, provides a loan to the importer in a foreign currency to finance the purchase of goods or services. So basically, friends, these are the four major source of getting the foreign currency loans. And when we when we classify these loans in the form of purpose, what by purpose, so it can be classified as working capital loans, project and infrastructure finance, and export and import finance. So what is working capital loan? These are the short term facilities designed to meet day to day business needs such as inventory financing, managing liquidity, general operational expenses. Project and infrastructure firms finance, foreign currency loans are utilized for financing the large scale projects or acquiring the capital assets, and they are offered with often longer repayment tenures, maybe 15-year, 20-year, and even more in some cases. And third is export and import finance purpose. One is pre-shipment finance and another is post-shipment finance. Pre-shipment finance is also known as packing credit. It is provided to the exporter to finance the purchase of raw material, processing, and packaging of goods before shipment. So whatever the activity an exporter do before pre-shipment, so whatever the amount that he need to complete those activities, and when the bank finance to such exporter is called pre-shipment finance. Once the shipment is done and customer exporter need money, so bank also finance such kind of exporter. It is called post shipment finance, provided after goods have been shipped to cover the period until the export proceeds are realized. Means whatever the credit period, whatever the time lag is between the from the date of export to date of realization, whatever the time is time lag is there, maybe 60 days, 50, 90 days credit period. So bank generally provide finance of this duration. It is called post shipment finance. So my dear friends, what are the key features and alternative of foreign currency loans? They are basically offered with either fixed or floating interest rates, and the interest rates is basically based on international benchmarks like SOFR, Euribor, Sonia, LIBOR, so which may be lower than the domestic rates. Generally it is presumed, or generally it happens actually. So now the question is, as we know, there is a risk involved in foreign currency loans always. The risk is called currency risk. So is there any instrument available in the foreign exchange market which can hedge such kind of currency risk? So there are various derivative instruments that are available to hedge this risk. So I am going to discuss about two well-known financial instruments that can be used for hedging the currency risk. One is currency swap, and second is foreign currency option. So currency swap is basically a kind of an agreement to exchange the notional principals or interest payment in different currencies to hedge against the exchange rate fluctuations. And second is foreign currency options. So foreign currency options is give the holder the right but not the obligation to exchange a currency at a predetermined rate on a future date. And this are foreign currency options or currency swap. These are basically over the counter kind of financial instrument which executed with the bank, and there are certain options, currency options, that are now listed with exchange, and they are exchange traded currency option as well. But more or less, as per their nature, they are mainly executed through bank over the counter. So hope, my dear friends, the information that I have provided you, the knowledge that I have shared with you today regarding how the foreign currency loan can be taken, and how what are the different types, purpose, and alternative of foreign currency loan is well understood, and you have gained some understanding, and your insight regarding this information has increased. I'm hoping that you will share my channel with your known, with your family, friends, and expecting a good positive comments from your end. I'll be waiting for your comments so that I'll be get more motivated to make more reliable and good videos with good contents. So I'll be coming with soon in a new video with a new topic, new concept. Till then, stay blessed, enjoy your weekend. Thank you very much. Jai Hind. Dhanyawad.